Question number 3. The following is the balance sheet of Week Limited. As on 31st March 2022. And we have been given reserves and surplus. In reserves and surplus, we have these losses. The following scheme of reorganization is sanctioned. All the existing equity shares are reduced to 40. So 100 rupees equity share now becomes 40 rupees equity share capital. Okay. And then all preference shares are reduced to 60 each. This becomes 60 each, new one. Apart from that, the rate of interest on debentures is increased to 12%, and the debenture holders surrender their existing debentures of ₹100 each and exchange the same for fresh debentures of ₹70 each for every debentures held by them. Two things are happening. One is rate of interest is increased to 12%, and 100 rupees debenture becomes 70 rupees. Okay. So what happens? 10 becomes 12, 100 becomes 70. New one. One of the creditors of the company to whom the company owes 20 lakhs decides to forego 40% of their claim, 8 lakhs. He is allotted 30,000 equity shares of ₹40 each in full satisfaction of his claim. Okay. Now, for the remaining 12 lakhs, equity share capital is offered. So, how many equity shares are offered? 30,000 equity shares of ₹40 each, 12 lakhs. To the extent reduced is called as capital reduction. And fixed assets written down by 30%. Current assets are to be revalued at 45 lakhs. Taxation liabilities of the company settled at 1.5 lakhs. Investments to be brought to their market value. It is decided to write off the fictitious asset. Whether stated or not, we have to write off this one. Anyhow, we have to incorporate these items in the original illustration. Let's see one after one. I'll just post. Let me first start with the equity share capital. This one, 100 rupees share becomes 40. So 100 rupees equity share capital is cancelled. Instead of that, new share face value being 40 is issued. The value being 100 lakhs becomes 40 lakhs. The difference between these two is the capital reduction, 60 lakhs. 60 lakhs. Second illustration, second journal entry is all about preference shares. 100 rupees preference share capital account debit to 60 rupees preference share capital. So now new face value being only 60. Earlier it was 50 lakhs. Now 60% will be offered. Balance will be forgone. That will be capital reduction. 20 lakhs. 10% debenture is cancelled. Instead of that, we now offer 12% debentures. That too only 70%. 70% being 28 lakhs. Remaining 12 lakhs will go to capital reduction. Apart from that, we have to incorporate for these transactions also. Creditors. 20 lakhs worth of creditors Out of that, 8 lakhs cancelled to capital reduction, 8 lakhs. For the remaining 40 rupees equity share capitals offered, 12 lakhs. 12 lakhs. Right. 12 lakhs. Then fixed assets written down by 30, it's a loss. Loss should be charged to the capital reduction account to fixed asset. Schedule number 3, we have full details of non-current assets. I'll just directly move on there. 125 lakhs. We have to reduce 30 percentage. We have to reduce 30 percentage. Okay. The new fixed asset being, after reducing 30 percentage, 37.5 will be subtracted, 87.5 will be the answer. The loss here being 37, that will be debited to the capital reduction account. Capital reduction account debit to fixed asset. To fixed asset. This value being 37.5 lakhs. Current assets are valued at 45 lakhs. Current assets. We don't have any other current assets, only we have 1 lakh, 100 lakhs. Now the current asset is revalued at 45 lakhs. Then how much is the loss? Okay, current assets are to be revalued at 45 lakhs. 55 lakhs loss. Current assets, 55 lakhs loss. Clear? Here we have done this one. We have done this one. Tax is settled at 1.5 lakhs. Earlier, we thought the tax liability being 1 lakh, but finally we paid 1.5 lakhs. So another 50,000 excess payment is your loss transferred to the capital reduction. So tax provision upon debit 1 lakh and capital reduction account debit 0.5 lakhs to bank 1.5 lakhs. Is that okay? Clear? Investment should be shown at its own market value being 9.5 lakhs. Earlier it was 10 lakhs, now it is only 9.5 lakhs. That will be totally scored out. Capital reduction account debit to investment. The value being 0.5 lakhs. Apart from that, all the fictitious assets are going to be written off. Can be clubbed with the same journal entry. So 2 preliminary expenses. 2 lakhs will be written off. 2 profit and loss. 4 lakhs should be written off. Hope I have incorporated all the adjustments here. All the adjustments also. Better we can have a working note for what? Capital reserve. If you want, you can prepare capital reserve account here. Okay. Now, in CR, 2 fixed asset. The debit side are being the losses. Usually, decrease in value of the asset, increase in value of the liabilities are the losses. And asset increase and liability decrease are being the gains. Fixed asset decreases by this much, 37.5. That amount will be adjusted in fixed assets. So hereafter the fixed assets being 87.5 lakhs. Tax provision is totally written off. And CR to bank for excess payment of tax, 0.5 lakhs. Bank is part of current assets. You can adjust this value in current assets, 1.5 lakhs. We have not been given current assets separately, but we can adjust here. 1.5 will be adjusted here. 1.5 will be adjusted in the current line, current asset. We assume this is being part of Cash is part of current assets. Like in CR, 6.5 lakhs to investment, 0.5 preliminary expenses, 2 lakhs, profit and loss, 4 lakhs. In those concern account, rewrite this, not 10 lakhs, 9.5 lakhs. Preliminary expenses already 2 lakhs we have debit, by crediting it becomes 0. Profit and loss already we have debit balance, by crediting it becomes 0. It becomes 0. Is that clear? Now, provision for taxation also 0. Schedule number 1 is totally 0. Schedule number 3, here 87.5 plus 9.5, how much? 98 lakhs, I think. Is that okay? 98 lakhs. So non-current asset, this becomes 98 lakhs. 98 lakhs. How much? 97 lakhs. Okay. 97 lakhs. Thank you. 97 lakhs here. Yeah. This one is all about current assets. Okay. I made everything appears in the single page. Here, equity share capital totally scored out. Instead of that, we have new equity share capital face value being 40. Here is 40 lakhs. Here is another 12 lakhs. Overall 40 rupees equity share capital now we have being 52 lakhs. 52 lakhs. In capital reduction by equity share capital. Reduction of equity share capital is a gain, so I post that value here, 60 lakhs. 100 rupees preference share capital is totally cancelled. Instead of 60 rupees preference share is issued. The new preference share capital being only 30 lakhs. In CR by preference share capital, the gain due to the reduction being 20 lakhs. 10% debenture cancelled totally. Instead of that, new 12% debentures were issued. So rather than 10, it becomes 12%. Not only that, the value being only 70%. Then overall value being 28 lakhs. In CR, reduction of 10% debenture in the credit side as it is being the gain for us. This value being 12 lakhs. Creditors decreases by 20 lakhs in current liabilities. You have to decrease by 20 lakhs. Hereafter, the new creditors being only 30 lakhs. Sundry current liabilities, we have new balance being 30 lakhs. Is that okay? Due to that transaction. So, this will be current liabilities 30 lakhs. Totally cancelled. And CR by creditors. To the extent of creditors foregone is my gain transferred to the capital reduction. And finally, current asset is decreased by 55. Current asset decreased by 55. So here, current assets 55 lakhs. In current asset, you have to subtract 55 lakhs. From 100 lakhs, 1.5 lakhs bank subtracted, another 55 lakhs. Also, value loss should also be subtracted. Then the ultimate value being 43.5 lakhs. Am I right? Is that clear? From 100, you have to subtract these two values, then it becomes 43.5 lakhs. Then schedule number 1, resource and surplus, already we knew this is 0. Schedule number 2, originally 51, where tax payment made 1 lakh, another 20 lakhs creditors forgone or converted. So, remaining current liabilities is only 30. And non-current asset is inclusive of two assets, fixed assets as well as investment. Fixed asset decreased by 30%, fixed investment is restated to the market value. Because of that, we lost another 50. So, overall new value being 97.5 and current assets also 43.5. Come on, get me the total now. What is the total now? 140.50. 140.5 lakhs. 140.5 lakhs. Huh? You have the balance, right? You have to tally this and find out if there is any balance. You have the balance, right? If you have the balance, that balance is transferable to the capital reserve. Okay, balancing figure. How much is this? 0.5 lakhs. Am I right? So that becomes reserves and surplus, a part of this one. In reserves and surplus, we now have new reserve, which is nothing but capital reserve, which is 0.5 lakhs. Now it's tally. Is that clear? Clear? We will move on to the fourth question. Now, balance sheet, and we have been given notes to accounts. Then these are the adjustment information you have to carry on. Capital reduction account is a nominal account. Capital reduction account usually will create only for a temporary purpose. Okay, like P&L account. Once we finish up the operations, there will not be any balance in nominal. Means this one. Okay, capital reduction account. Whatever the balance left over, we'll go to the capital reduction. So capital reserve account. That's a part of other equity. That is a part of other equity. Okay, reserves and surplus like. This one I think 120 lakhs. Correct in text. 120 lakhs. The following scheme of internal reconstructions was framed, approved by the court. All the concerned parties are implemented. All the equity shares are to be converted into same number of fully paid equity shares of rupees 2.5. So equity share capital converted into 2 rupees 50 paise equity share capital. Directors agreed to forego their outstanding remuneration. Directors, their remuneration is going to be forgone. The debenture holders also agreed to forego outstanding interest in return of their 12% debenture being converted into 13% debentures. 12% debenture is converted into 13% debenture. Whatever the interest outstanding, they say we no need to get it back. You no need to give this for us. The existing shareholders agreed to subscribe for cash, fully paid equity shares of 2.5 each for 125 lakhs. New issue, new equity share capital. 2 rupees 50 paise equity share capital, 125 lakhs. 125 lakhs. Trade creditors are given the option of either to accept fully paid equity shares for the amount due to them or to accept 80% of the amount due is in cash. Creditors. Okay. They are given two options. Do you want to convert your due into equity share capital of rupees 2.5 each or cash? If they want to take up cash, we'll settle only 80%, balance goes to capital reduction. In case of equity share capital, we'll convert equivalent value in equity shares. Creditors for 65 lakhs except equity shares, this one is 65 lakhs. Whereas those of 100 lakhs accept 80 lakhs cash. For 100 lakhs, as per the terms of agreement, if you want to get the cash, you will get only 80%. Balance 20% you have to buy one. And assets are revalued as follows. Land and building and all. So we'll try to finish off first this set. We try to finish off this set. Clear? We'll try to finish up this set. Yeah. Very simple. Equity share capital is converted. We already have 10 rupees equity share is converted into 10 rupees equity share capital account debit to 2 rupees 50 equity share capital. Originally it's 500. Now we offer them only 1/4 worth 125 lakhs. Balance 375 is nothing but capital reduction. Capital reduction. Clear. Directors forgone their remuneration. Maybe it may appear in current liabilities. Let's see here. Directors. Outstanding directors remuneration. They will forego this completely. Then entry for this being entire 10 is cancelled. Directors remuneration account debit to capital reduction. This value being 10 lakhs. Fully gone. 12% debenture converted into 13% non-current liabilities. In case of non-current liabilities, 400 plus 48. This one is cancelled. For this, only rate is changed. Rather than 12, it is now 13. So 12% debenture is cancelled. And instead of that, they are getting 13% debentures. The value being 400 lakhs. And because of rising the rate of debenture from 12 to 13, any existing outstanding interest they have they say we don't want. They just go for waiver. So outstanding interest on debenture is now scored out fully. That will go where? Capital reduction. Value being 48. 48 lakhs is cancelled. A fresh equity shares also issued for 125. Normal issue. 2 rupees 50 paise worth equity share capital is issued to bank. This value being 125 lakhs. 125 lakhs. Also, in case of creditors, the arrangement is this way. What is the total creditors we have? Current liabilities 165. So for the entire 165, for 65 worth, we have offered them equity shares. For the remaining cash is offered. I'll write that here. Creditors account debit. The overall amount payable to the creditors being 165, where we offered 2 rupees 50 paise equity share capital for rupees 65 lakhs. And immediately we made a payment bank 80 lakhs, because for this 100 lakhs worth creditors they demand cash settlement. In case of cash settlement, we pay only 80% of the value. Remaining goes to my benefit, otherwise named as capital reduction. This value being 20 lakhs. So we have completed all these transactions. Now we have to go for adjusting. Okay. Assets value. The assets are revalued as under. So we have been given 4 assets. These 4 assets are going to be revalued. Let's go here. Here we have land and building 230, earlier 184. So increase in land and building gain. So land and building account debit. How much is increasing? Land and building 30 plus 6, 46 rupees is increasing, 46 lakhs. Next, plant and machinery 220, earlier 286, it is decreasing. So decreasing. 2 plant and machinery, 66 decreasing. Stock 120, earlier 142, then stock value also decreasing. I am passing 2 entries. Those assets losing value will be combined as one entry. Those values are increasing, combined as another entry. So I just categorized into 2 so that it may be combined entry. In case of stock, 142 becomes 120, there is a loss of 22 lakhs. Debtors also will have a loss of 4 lakhs, 2 debtors. 4 lakhs. Clear? Always remember, intangible assets like goodwill will have no value. The company has lost its image. That's why it's going for internal reconstruction. Hereafter, there will not be any goodwill. Always wipe off that goodwill, to goodwill, whether it is stated or not. And any accumulated profits or losses, profit and loss, whatever thing you have, no more required, should also be wiped off. So we have these 2. Of course, you can use a capital reserve also for the requisite purpose. Once the company is supposed to go for reconstruction, whatever the available gain also be utilized for the capital reduction purpose. So 390 and 8, first of all, we are using this to written off in the capital reduction account, 390 and 8. So 2 profit and loss, 390, and 2 discount on issue of debenture, 8 lakhs. Apart from that, capital reserve can be converted into capital reduction account. So capital reserve. In order to, I just write it fully, not to confuse with our 2 CR here. Capital reserve, the value being 6. This is transferred to capital reduction account, 52 lakhs. This is how you can pass the combined entry also. Find out if there is any fictitious assets. We don't have any fictitious asset. So I'll post all the journal entries in single page. This will be ended with capital reduction. And this one, here. Clear? Then what can we do? So I have completed posting the passing the journal entries. Better we can prepare CR account also. CR account. Okay. In the first entry, equity share capital gain. So credit side, equity share capital 375 lakhs. Second entry, directors remuneration 10 lakhs. And outstanding interest on debenture 48 lakhs. And land and building and capital reserve. See, if we have surplus in capital reduction, transfer to the capital reserve. Already we have capital reserve, use it. So I am using it now, which is 46 and 6 lakhs. Here is due to the creditors we gain. By creditors 20 lakhs we gained. And because of these reasons we face loss. What are they? Plant and machinery 66 lakhs, stock 22 lakhs, debtors 4 lakhs, goodwill 15 lakhs, profit and loss 390, discount on debentures 8 lakhs. Find out the balance if any exist. Huh? 505 total tallied, right? So 505 tallied, we don't have any more balances. Clear? So we just posted all the items related to capital reduction. Rest now I am going to post. Rest 10% equity share capital becomes cancelled completely. Instead of that, new equity share capital of rupees 2.5 emerges. Here is 125. Here is another. Okay, this entry should be reversed. I made a mistake. Bank to equity share capital, isn't it? Bank to equity share, issue of shares. Bank to 2 rupees 50 paise equity share capital. Careless mistake. Okay. Now, already we have 125. Another 125 fresh issues there. So the new equity share capital being 250. Directors remuneration cancel. Directors remuneration. So where is that? This one becomes 0. This one becomes 0. And then 12% debentures becomes 13% debentures. I cancel the 12% debenture, then it becomes 13% debenture. So it is cancelled, new debenture being 400. And then next one being outstanding interest is totally cancelled. So this becomes 0. This becomes 0. Then bank account 125. Bank account 125. Do we have the bank here? Yeah. 27 bank we have here. Okay. 27 bank we have. So what happened? We have to add another 125. Here is 80 rupees payment to the creditors. Net surplus we have being 45. Can be added with the cash balance here. 45 is added with this. 27 plus 45. What is the value? 27 plus 45. 72. 72 will be the new cash balance. Land and building now increased by 46. Land and building, here is land and building increased by 46 to 30. And then capital reserve is totally used. So hereafter we don't have capital reserve. This becomes 0. Okay. And then creditors totally scored out. Creditors totally scored out. Now we don't have creditors. Here is one more equity share capital 65. So you have to add that 65 with this 250. Then it should be 315. New equity share instead of 10 rupee share is this one. Fresh issues 125. Shares issue for the creditors being 65. Overall value being 315. Is that clear? 315. That's how you can post and give the tick marks or do not make many mistakes. And this one also is already posted. Now we have to show all these things. P&L account, discount, goodwill. All the three were cancelled, scored out. So this becomes 0, this becomes 0, this becomes 0 in total. So everything is scored out. So schedule number 1 becomes 0. Schedule number 1 becomes 0. Plant and machinery, you have to reduce by 66. Stock reduced by 22. Debtors reduced by 4. So plant and machinery reduces by 66. Then this is 220. Debtors reduces by how much? 76. 4. Stock reduces by 22. Then it is 120. Goodwill fully reduced. Furniture fixtures, no adjustment, remains the same. Yeah, come on. Total the fourth schedule. 0, 230 plus 220, 450 plus 41, 491. So the new total for the non-current assets schedule number 4 being 491. 491. And schedule number 5, 120 plus 76 plus 72, 268. So schedule number 5 being 268. Now here we have only 400 for the schedule number 2. Here we have only 400. And in current liabilities, 11 and 33 remains as it is, 44. Okay, here it is being 44. Total being 759. Okay, 759. Yeah, make a note of it. So first page I have journal entries and new balance sheet. In the second page I have the schedules. Okay, after the modified schedules. Come on, finish up copying the first page. Once it is okay, then I will show the second page to be copied. Clear? It's very simple. Now, question number 5th is one of the interesting illustrations. Green Limited had decided to reconstruct the balance sheet since it had accumulated huge losses. The following balance sheet of the company on 31st March 2021, before reconstruction is given here. Equity and non-current liabilities, current liabilities, and we have been given the assets also. Yeah, of course, here we have goodwill also, one of the intangible assets here. Usually, in case of internal reconstruction, goodwill is useless. Check whether the capital reduction is sufficient enough to write up that one also. In that case, whether it is stated in the question or not, you can write up this. Right. Here, one of the interesting illustrations. Very often, similar illustration was asked. In CA itself, they have asked twice at inter level. In the earlier days, it was in final level. Now it is inter level. In CMA also at the final level, we saw similar illustration in most of the cases. Slight modification slide. So I have incorporated that here. In this particular company, assume that X and Y are the predominant owners. The following is the interest of Mr. X as well as Mr. Y in Green Limited. So one of the beautiful illustration. Mr. X being the debenture holders as well as Mr. Y for the first and second debenture. For first debenture 300 plus 200 almost 500. Overall non-current liabilities in first debenture being 500. The entire 12% first debenture held by only two parties, X and Y. Clear? What is called first debenture and second debenture? Usually, in case of closing the company, liquidating the company, the order of payment to the various contributors may be pretty different. Secured liability will be paid off first, second unsecured liability. While moving on to the payment to the unsecured liability, beforehand, debenture holders will come. Because they have the floating charge. Fixed charge and floating charge. If you pledge a land and building and borrow, then that borrowing is called fixed charge. If you are not able to pay, the lender will possess or take your own property as attachment for recovery of the money. This is called fixed charge. Floating charge means you borrow based on some assets as a floating charge. Okay, if you fail to pay anything, the banker has the rights to attach any of the property you have by the time. Usually, floating charge will be given on stocks. Land and building can be used as a fixed charge. Stock can be used as floating charge. Why? In case of land and building, you are going to register the loan borrowing with your property. You can enjoy the possession of that. The ownership right is now having some encumbrances. This is called encumbrances. Once it is registered, you cannot sell your property without their permission. So you have to get the permission from the lender. You can keep, possess, enjoy, you do whatever the things you want to do, you can do with that land and building, but you cannot sell because it has a fixed charge. In case of stocks, you can buy and sell, no problem. You can buy and sell. You show to the banker, sir, on average I have around 10 crore rupees in stock investment, sir. If you go for some stationery mart or grocery mart and cloth merchant, huge money they invested in the stocks. But they need loan. If I have the land and building, I can simply pledge and I can use the land and building. But in case, if I want to pledge my stock, what happens then? The lender says, stock you pledged, you should not sell. How can I, sir? I have to sell the stock only to make the profit. If I pledge, then I cannot sell, means what's the use? In case of land and building, pledge and use, capital asset. In case of stock, if I pledge, if I don't sell, then how can I do the business? Then the lender says, no need to worry about that. Based on the stock you have, I will give the loan. Can I sell the stock? Of course you can sell. The moment you sell, you have to replace the stock for the next business. Sell, buy new one. Sell, buy new one. No issues. While borrowing, you may pledge stock A. You borrowed. Later you sold A. Instead of that, you purchased new asset, new stock B. Okay. But if you are not in the position to repay the loan, immediately the banker will come. You are not able to pay the loan. You are defaulting. So I will attach this property. Then you are now asking with them, sir, I have shown only A. No, you can means attach only A. That property is not going to be attached now. Whatever the stock goes out, the pledging on that moves out. Automatically new asset will come into the pledging. The new stock B comes under the pledging. My rights in B also. In case of fixed charge, you have the charge only on the land and building. In case of floating, whatever the asset moves out, they just release it. And automatically new asset comes in. On that I will have the floating charge. I will have the charge. That will be applicable only in the case of stocks. This will be called as floating charge. All the debenture holders are having the floating charge. Okay, all the by default, all the debenture holders are having floating charge. At your foundation level, you might have studied. Okay, collateral security. Collateral, there I have taught this logic. Go and see that video if you want. Okay, collateral security. So by entering into the collateral security, they will get additional security. Usually debentures will be issued. So secured creditors will rank first in the case of settlement. Second, automatically debenture holders will come because they have the floating charge. Whatever the asset they have, the business has, they have the right. Third, then unsecured. Thereafter, preference shareholders, last equity shareholders can get their own contribution. In debenture, again, two debentures are there. First debenture, second debenture, third debenture. While making the payment, first I will pay to the first debenture. If money sufficient enough to pay them and still I have the surplus, then I can go for paying to the second debenture. Okay. Third debenture. Okay. This is how we have the debenture 1, debenture 2, debenture 3. First debenture will have the early right than the second debenture. Usually. So, secured creditors will fall under the first, then debenture holders will fall under the second category. Among the debenture holders, if I issue this being the first debenture and second debenture, this fellow will get first and then this fellow will get. That's the right. Hope now you'll be able to understand the term first debenture and second debenture. Anyhow, it's coming under company's law. As the term is here, I just explained what is called first debenture and second debenture. The first debenture is now held by X and Y. Second debenture also held by X and Y. Apart from that, some of the creditors are also meant for X and Y. And they are being the shareholders also for equity shares and equity share partly paid up and fully paid up also we have. Okay, this much extent. This much extent. Now see, first debenture 500, second debenture 1000. Total how much we have? 500. This one being 1000. What about the outsiders? Nothing. All the first debenture the company has 500 is for X and Y. Second debenture 1000 is also for X and Y. Now what about the creditors? Current liabilities, we assume this may be the creditors, 500. Out of that 500 rupees, 200 and 100 is payable to X and Y. Outside creditors being 200. Similarly, 50 rupees equity share, we have 7,500. 7,500. Out of that, currently paid up being 2,500. This is authorized. This is what about the current issue, 2,500. Out of the 2,500, 300 and 200 is for X and Y. Balance 2,000 could be held by the outside equity shareholders. And in case of partly paid up, 4,000 rupees. Out of 4,000 rupees, 500 held by, 500 held by X, another 500 held by Y, 3,000 held by the outsider. Okay, that's how you can assume. That's how you can assume here. Now let's see. The following scheme of reconstruction is approved by all parties interested and also by the court. Number 1. Uncalled capital is to be called up in full and such shares and other fully paid up shares be converted into equity shares of rupees 20 each. Okay, uncalled up capital should be called up full. Thereafter, the converted one and existing everything is converted into 20 rupees equity shares. Let me finish off passing the journal entry for this one first of all. 1 lakh 50 rupees shares called up to the extent of 40, remaining 10 is going to be called up now. Remaining 10 is called up now. So for that, the journal entry being equity share bank account, equity share call account, equity share call account debit to equity share capital account. The value being 10 into 1 lakh, 10 lakhs. Otherwise, rupees in 1000. So I cut the 3 zeros, only 1000. 1000 thousands. Is that clear? Now I collect this money, bank account debit to equity share capital, equity share call account. 1000 collected. After that, all the shares becomes fully paid up 50 rupee shares. This is 2,500. This is 5,000. Is that okay? 7,500. Now that 50 rupee share is converted into 20 rupee shares. Converted into equity shares of rupees 20. It means 30 rupees is going to be cancelled, transferred to the capital reduction account. Clear? Let's see. Equity share capital. 50 rupees equity share capital. 50 rupees equity share capital account debit. 7,500 to 20 rupees equity share capital to capital reduction. 40% is the new value, 3,000. 60% is cancelled, named as capital reduction, 4,500. Is that clear? Is that clear? So the partly paid up share is converted into fully paid up. For that, we have passed the journal entry. We collected the call. First one is all about due entry for call. Equity share call account debit to equity share capital. By passing this entry, we now confirm 10 rupees is recoverable. The next entry, we recovered the 10 rupees. Now we have almost 7,500 rupees worth equity shares at the rate of 50 rupees each, converted into now 20 rupees equity shares by cancelling 30 rupees per share, which is called capital reduction. So I have just passed that in capital reduction account. Clear? Now, next one, second one. Mr. X is to cancel. That second and third is very, very important one. So let's see. The adjustment number 2 and 3 clubbed and passed here. So now the beautiful adjustment. So adjustment related to these two were already over. What are they? These two were over. Now we have this component, this component. Is that clear? C. Only this component. Only this component. Equity shares treated. While making the adjustments for the equity shares, not only outsiders equity shares, X and Y also being the equity shareholders, for their share also got adjusted. That's separated. That is separated. Now here. After that, X and Y, other than equity share, the company has to pay for them for first debenture, second debenture, and sundry creditors. Together with all the amount payable to X being 1200, for Y it is 600. Now the adjustment number 2. Mr. X is to cancel 700 of his total debt other than share amount. Share amount was already separately treated, forget about that. And to pay 200 to the company. This fellow has to pay 200 rupees. So we received 200 rupees from him. Then 1400. In that 700 rupees is cancelled. To the extent we cancel, that is our gain. Balance 700. For the balance, to receive new 14% debentures for the balance amount. So 14% debenture is issued. What happens here? Mr. X, who has given to the company 300 rupees for first debenture, 700 rupees for the second debenture, 200 rupees for the sundry creditors. As for the second term, overall payment 1200. No, leave it. Give me another 200 rupees. That's how we demand. Automatically, the amount now payable to them is 1400 rupees. Out of the 1400 rupees, we ask them to forego some extent. He says 50% I will forego. So out of 1400, 700 is forgone. What about the rest 700 rupees, sir? How will you settle? I will give 14% first debenture and new one. Okay, new one is issued. Similarly, in case of Y, cancel 300. Cancel 300 to the extent he cancels is my gain, capital reduction, other than the equity shares, and accept a new 14% debenture. So overall payment being for 600, we have not received any cash from him. The due amount recoverable as a payable to Y is 600. By negotiating, we offered only 300 rupees worth of 14% debenture. From this, we gained another 300 rupees. So I have clubbed these two entry into single entry line. Now I am going to pass the entry for this. What is the journal entry? 12% first debenture cancel. 12% second debenture also cancel. This is around 500. This is around 1000. Creditors around 300 only for X and Y, not the outsiders. Apart from that, we get the cash from one of the debenture holders, Mr. X, which is 200. For all this amount, we ask them to take only 14% first debenture to the extent 1000. Because of this reason, we gained 1000 rupees transferable to the capital reduction. Hope so you will now understand. The working note means adjustment number 2 and 3 clubbed and worked out as a single journal entry here. Clear? Okay, I will take this here. Clear? So working note number 1 is all about uncalled up capital is called up and made the partly paid up into fully paid up. Thereafter, 50 rupees share is converted into 20 rupees shares, 30 rupees is the capital reduction. Second and third is all about the mode of settlement to two of the clients of debenture holders of ours, X and Y. From X and Y, we issued and collected the money. For that, first debenture, second debenture, and creditors all put together a part. For all this amount, along with another 200 rupees we received from X, we offered only 700 rupees worth of 14% debenture. Balances means cancel as capital reduction. The same happens for this third one also. We pass the entry for second and third put together as a combined one. Fourth one, the amount thus rendered available by the scheme shall be utilized in writing off of goodwill, profit and loss. And if there is any balance, can be used for writing off the computers. Now, what are the fictitious assets we have? We have intangible assets, and any balance we have can be used for writing off of this one. And any accumulated losses can also be written off. Is there any accumulated losses? Yes, 2000. Now, I debit the capital reduction. This capital reduction can be used for writing off of the losses, profit and loss. How much we have? 2000 rupees. Not only that, we can write off the goodwill also. The goodwill in this case being 2000 rupees. And how much balance we have in capital reduction? Here is 4,500. Here is another 1,000. Overall capital reduction we have is 5,500. We no need to pass the journal entry here. I mean, so we no need to open the capital reduction account because we have only two items in the credit. 4,500 for equity shares, and due to various other contribution we get another 1,000 rupees. So overall we have 5,500. Out of the 5,500, 2,000 is used for writing off the existing loss. Another 2,000 is used for writing off the goodwill. Still we have 1,500. That 1,500, if we still have anything, can be used for writing off the computers. Okay, so 2 computers. That value being 1,500. Available amount. Now score of everything. So we have passed the entry here. That's all. That's all. Now let's see. Equity share capital, call, debit, credit got eliminated. Then this equity share capital is completely scored out. 2,500 plus 4,000 plus 1,000, 7,500. That 7,500 rupees worth the equity shares cancel. Instead of that, new 20 rupees equity shares emerged. Okay, 20 rupees equity shares. For how much? 3,000. 3,000. And capital reserve account got closed. There is no balance. Now, first debenture, second debenture, both are cancelled. Instead of that, we get new 14% first debenture worth rupees 1,000. Creditors cancelled by 300 rupees. Now the new creditors being 200. And bank balance 1,000 rupees we get due to call. Another 200 rupees we get from one of our debenture holders, 1,200. So we have no cash. Now we have to include the cash also here. Cash. There is no current assets. So we now include current assets here. The value being how much? 1,200. 1,000 plus 200. 1,200. And then P&L account scored out completely. It becomes 0. Goodwill, computer, both are written down. Goodwill completely written off, 0. And this one is written off to 1,000. 1,500 is scored out. So this is 1,200. No change in building, no change in plant. So overall new value could be 4,200 in the asset side. In the liability side, 3,000 plus 1,000 plus 200, 4,200, we have the balance here. Now it's now tallying right. Clear? Come on, make note of it.